Yesterday we finished the first chapter, that is the introduction to the different securities, and we can say the portfolio. What is the portfolio? What is the role of the portfolio manager? Okay, we understand the different securities. First, we understand what is security. That is the financial instrument in which the investors invest his funds, his money in the hope of the return in the future. Okay, and we understand the different investment avenues. We understand the traditional investment avenues like the stocks, okay, bonds. Also, we understand what are the modern day investment avenues, like the cryptocurrencies, like the we can say the investment in the private equities, and all these things we understand in the last sessions. We also understand what are the different factors who has the impact on the investment. We understand the investment environment. We now know the different participants. We can say the different stakeholders, okay, who plays the important role in the investments, like the government, like the regulatory bodies. Yeah, we can say the investors. So all these we understand in the previous sessions. Okay, now we also understand what is the investment process. First, we set the investment objective. Okay, the goal. Then what the any investor do? He analyze the market. He understand what are the different investment avenues available to him or she, to him or her. Okay, so all these so after completing this analysis part, the investor made the well-documented plan. And after that, we can say after making the plan, he execute the plan. He actually start investing in a different portfolio. And after that, he continuously monitor and review his different investment. Okay, like that he made a portfolio, and after we can say making the portfolio, he continuously observing his different portfolios. Okay, so what return he's getting, what is the risks associated with that investments. So all this part that is the investment process. So all that we understand in the first chapter. Now we consider that the investors is already invest his money. Now he how he analyzes the risks and return which he is getting on that investment. Okay, so that part we covered in chapter 2. Okay, so in chapter 2 we will do the risks and return analysis and understand the investment dynamics. Okay, so in that chapter we understand the essence of the risks and return. What are the different risks associated with the investment? Okay, and whenever the and what type of risks give the investors the highest return, which type of risk gives investor a lowest return. Okay, what is the exact relationship between risk and return that we are going to understand in this chapter, in these sessions. Okay, so we can say the risks and return are always we can say the collinear with each other. Okay, so you cannot avoid the one with another. Okay, so we can say the risk and return are always together. Okay, so when we can say there is a direct relationship between risk and return. Whenever you take the higher risk in the investment, you may get the highest return as well. But we can say in that case, the highest risk is also associated with your investment. That means you may have the losses in the future. So the risk and return, you can say you can't have one without the other. That means if you want the higher return, then you must have the higher risk associated with that investment. Okay. If you take the low risks, then you will get the lower returns. Okay, so these both always they comes together and live together. So now we can say, if you see in the image, so there is a one board. That means if you, we can say, follow the path of investment, and then the risks and return, we can say, comes together. Okay, so there is a one board, that is a high risks and high return are the, we can say, the two sides of the coins. Okay, if you take the one, you will get the other. Okay, so we can say, in the risk and return, we can say, what is the fundamental principle? The higher the risk generally leads to the higher potential return, but you may lose your investment because the risk is higher. If the things are go as per your expectations, if the cards, if your cards is on the right place, then you will get the, we can say, higher return as well. While the lower risk typically result in the lower potential result. That means if you don't have that guts, that ability to take the higher risk, and you want the safe investment, because you fear of the loss of your money, loss of your funds, then whenever the investment takes the lower risk, he'll get the lower return, but his investment is, we can say, much safer as compared to the higher risk investment. Okay, now if we take here, one real world example is given, that is investing in the startup stock carries the risks of the total loss. Okay, so whenever there is any startups starts by the any, we can say, the college dropout or the just college parts of students like you. Okay, but if you have a good idea and you take the investment from the family, your friends, relatives, okay, so the risk associated with such a type of investment is high. If you, because we can say we can say the startup, it may be, we can say, the possibility that the startup may succeed very well, but it may be also the possibility of the business is, we can say, not established very well. In that case, those who invest the amount in the startup may lose all the amount. That means that carries the risk of the total loss, but the potential for the, we can say, the good gains. Okay, if the startups is going well, then they'll get the, we can say, the good returns. If you take the some examples of the, we can say, well-established startups in India, like the, we can say, the Flipkart, or we can say the boat. So all these are the small startups, like the some of the companies on the international level, like the Amazon, Facebook. So in the starting, all these are the small startups, but now they are we can say the converts into the big multinational organizations, all the multinational companies. Okay, so, but we can say that startup gives you the higher return in the future if they, we can say, in future they do well, and the business will get established in, we can say, a good manner. And then, but if it is not, we can say, happen, then you may lose the all the investments. So this is the one of the example. So what we can say the risks in the investing. So whenever any investor invest his amount of money, what are the different risks is associated with his investment. So here are some of the risks uh, we are going to understand. First one is, we can say, the market risk. Okay, as we all know that, so market, we can say, maybe the volatile at some of the times. Okay, because in market we know the investment is always have the impact of the investment environment. Okay, you cannot put the investment in a vacuum. Okay, that means you have to invest your amount in some of the in the market where there is, we can say, always the environment around that investment. So some of the factors who has the impact on the investments, the factors such as, we can say, the economical slowdown, economical recession, we can say the political instability, we can say the some of the natural calamities like tsunami, earthquake, we can say the situation like the COVID-19. Okay, so such factors may negatively affect the market conditions. So in such a situation, investor may have the huge losses in the futures. But if all these factor, we can say, is in favorable of the business, if the political parties is in a power, is, we can say, is favorable for the businesses in the nations. Okay, so they work for the ease of doing business in that country. Then at that point of time, the investors will get the very good returns. So the market risk is one of the most important risks. So the every investor has to think of or consider while doing his investment. Now, next one is, we can say, the credit risk. Okay. So in, we can say, uh, in the chapter, we can say, in the subject, the financial reporting, we understand the balance sheet. From balance sheet, we measure the financial position of the organization. That means the investor can understand the credit worthiness of the organization. That means the organizations will able to pay in futures or not. If the financial position of the organization is not good, then he'll, we can say, default in the future. That means if you invest in that organizations, so it's, we can say, the possibility is less that they will repay your investments, your money. Okay, so we can say there is always the default risk or the credit risk associated with the investment. That means if you invest in the organizations, that the organizations may default. That means the organizations may tell you that we don't have the enough cash, enough money to repay your loan or your investment. That is we called as the credit risk. So the possibility that the borrowers will default on the debt payment, that we called as the credit risk. As we know that the some of the times the banks provides the loans to the individuals to buy the house. After the, we can say, the 2 3 years, now the buyers tells that I am in a position of we can say we can say the incapable to pay the loan. So that situation we called as the credit risk. Some things happened in the investments. The, we can say, in whatever organizations or the company investments, when we invest the funds, now the company tells us after the sometimes that the organization's company is not in a position to repay. So that risk is the credit risk. So before we can say invest any amount of money into any organizations, first investor must need to check the credit worthiness of the organizations, must try to analyze the track record of the organizations. Okay, or must try to, we can say, first find out the financial position of the organizations, if they have enough liquidity with them or not. Now, next risk is the industry risk. Okay, we find some of in some of the industry, there may be the slowdown or the recessions we generally find. From last few years in 2008, when there is a, we can say, the world economy is in a recession because of the, we can say, the uh, some of the investment banks in America were bankrupt. So at that point of time, so banking sector and the software sectors, we find the a slowdown. Okay, so or recently in automobile sectors also we found a slowdown. Okay, so the specific, we can say, the like whenever this certain industry or the sectors have this slowdown. So at that point of time, if you invest in such a industry, such a sectors, so you may have the less return or you may have the losses as well. We can say industry risk also are one of the we can say the important risks associated with your investment. Now, next one is the industrial risk. So, in international finance, as we understand what is the currency exchange rate, we know the currency exchange rate fluctuates on a daily basis. It's calculated based on the demand and supply of the different currencies on the we can say on the international level. So, if you are doing the business on the international levels, you made the international investment. So at that time, if the currency exchange rate fluctuates at a very fast pace, or we can say if there is a political instability in some of the regions like the Middle East, Arab areas. We can say the Ukraine-Russia war. Okay, so India, Pakistan conflict. So in such a situations, it is the we can say that means it is not the business favorable environment. So we can say the business will not flourish very well in such conditions. So you may have the risk associated with your investment. So you will get the less return, or you may have losses in futures with these investments. So that's we called as the international risk. Now next one is the project specific risk. If you invest in such organizations, okay, so there we can see the main revenue they generates from the sum of the projects. Like the organizations, like we can say the some of the software companies like the TCS, Infosys, Cognizant. Okay, if you don't, if they don't have the enough projects with them, okay, so they don't generate the revenue. Okay, uh, if you say if you invest in the project specific organizations of the companies, if they don't have the enough projects with them, or if the projects we can say stuck in the middle, then at that point of time, the yeah, the investors have the low return, or he may have the losses in the future. Now, next one is now we understand what are the risks associated with the investment avenues. Okay, so we understand all these five risks, that is the market risk, the credit risk, industry risk, international risk, or the project specific risk. Now we understand what is the return. Okay, how we calculate the return from the first sessions, you guys heard that is return, 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 but how it's calculated. Okay, so that we are going to understand. So return represent the gain from the investment. Okay, so typically expressed as a percentage of the original investment amount. That means, for example, if you are taking that if I have the 100 rupees and I invest the 100 rupees in any of the organizations, for example, I invested my 100 rupees in a Cognizant. Okay, so the if I in the next year if I calculate the return, how I am going to calculate? If the valuations of the company increases by we can say the 50%. Okay, if I invested the 100 rupees, that means with this same space, my wealth also gets increases. Okay, so my 100 rupees will be the 150 rupees. That means my money also gets increases with the same percentage as the percentage company is growing. So now the value of my 100 rupees is the 150 rupees. And if the company give me the we can say the 6 rupees dividend, that means I will have the 156 rupees in a pocket. That means at the end of the next year, you can say my return is the 56%. I invest only 100 rupees, and in the next year, I will have the 56 rupees extra. That means the invest, we can say I will have the 56% return. So here is one example is given, that is the if you invested the $10,000, initially in any of the organizations. Okay, and if I sell that $10,000 shares, okay, after the we can say after, let's take the 6 months. After the 6 months, I sell the same shares for the 12,500. That means I gain 2,500 rupees extra. Okay, and company pays me the dividend of the $150. That means the total gain of mine is the 2,500 plus 150 rupees. That means totally I gain 2,650 rupees. Okay, so that is my return on my 10,000 investment. That means I initially invested the $10,000, and after 6 months I have the 2,650 rupees of. Okay, so that is my return. Okay, so in percentage we calculate. So the here is the formula of to calculate the return is given. So return is equal to total return divided by purchase price into 100. So here our total return is the 2,650 rupees. So we put that is in the we can say in the numerator, and in the denominator we put the purchase price. That is initial purchase price is the $10,000. So if we calculate the we can say the 2,650 divided by 10,000 into 100. So that is the return is 26.5% total return on my investment. So this is how we calculate the return. If you calculate the return, we can say the annualized return. So here is the one formula, that is 1 plus r raised to power 1 minus 10 minus 1. So r is the total return. So my total return is we can say the 26.5%. Okay, and n is we can say the number of years. If I consider here they consider the 3 years, so the annual return is the 8.83%. So this is how calculate the returns and the annualized return by using the formula. Okay, so now we know the different risks associated with the investment. We also know the how return and the annualized returns will be calculated. Okay, so now if we take the higher risks, we'll get the that highest return. That the percentage here we found that is 26.5% annually. So that percentage maybe is on higher side if we take the higher risk. And if we take the lower risk, then we will get the lower return as well. Okay. So this this is how we calculate the risk and return associated with the different investment. Okay. Now in the next part we are going to understand the how we can say the risks, how the risks calculated in the numbers. Okay, we will going to we can say learn some of the formulas for the risk calculations. Okay, and we also calculate the, how do we quantify the relationship between what we might gain and what we might lose. Okay, so that we are going to understand from this some of the we can say formulas. So the risks we can say the risks formula is given uh, here, that is risk is primarily measured by the variability of returns and typically through the statistical measures like the standard deviation. Okay, so we can say how if you analyze the past few years data, okay, so the steady return is getting on that investment or not. Okay, so that we are going to understand, and we check the we can say the volatility. We are going to check the standard deviation. What is it? If the deviation is higher, then we call it as the higher the risk. If the deviation is lower, then we call it as the lower the risk. So here the standard deviation formula is the square root of summation of I1 to n in bracket xi minus we can say u raised to power 2, that is the square, divided by n. N is the number of periods. So U is the average returns that yearly getting on the investments, and the XI is we can say the each individual returns getting by the investors. So on that basis, we calculate the standard deviation. If the we can say higher the standard deviation indicates the greater volatility. That means higher the risk. So in that case, you may get the higher return. Okay, so we can say seen the formula of the return as well. Okay, so that is the percentage return divided by the initial investment to 100. So this is the formula for the return. Okay, if your standard deviation is higher, you will may get the higher return. Okay, but it is also maybe a possibility that you may lose all your funds, all your investments. Okay, if your we can say the standard deviation is lower, okay, so that means you will get the lower return. But your sell we can say investment is the safer in many of the aspects. Okay, so the we can say the portfolio risk is affected by both the individual asset risk and how the asset moves in relation to the each other. That means we can say the risk and returns will we can say move came together. So we can say we understand. So what is the investment? Is the less risky? What are the investments are the more risky? That is the risk return trade-off for the different investment avenues which are available to the investor. So the treasury bills is if you say so here is we can say it is the we can say graph like charts. Okay, so we can say who is the highest one is the more risky, who is the lowest one is the less risky. So the treasury bills are the bills which are actually issued by the government whenever government need the funds for the shorter period of time to fulfill their deficit. Okay, to fulfill their budget deficits. Okay, as we all know that government came with the budget every year. They came up with the social development plans, the social development in education, social development in healthcare, social development in we can say the road infrastructure, social uh, shelter for the poor, education for the poor. So all these schemes were implemented by the government. So for that purpose, the government requires the fund. So the what is the income of the government? So government we can say collect the taxes from the people. But if the income is not enough to implement these social schemes, then what government do? Government raise the funds through treasury bills. Okay, for the shorter period of time. Okay, so RBI issued the treasury bills through RBI, and the those who are having the funds, they are having the money buy these treasury bills, okay, on a discounted rate, and after the maturity, that is within a year, they will get their, we can say, face value amount. That is after the maturity, they will get the return on the that is the discounted rate. Is the return of the investors. Okay, so treasury bills is issued by the government, and that's why it is we can say a safe investment because the government is we can say the protector of the interest of the investors, and that's why the treasury bills or the government bonds are the safest investment. Okay, because we know that the default risk is very less because the entity who is raising the fund is the government itself. Okay, so it's a very less chance of default, or we can say the credit risk is very less in this such a type of investment. That is the treasury bills. Now, next one is the corporate bonds. Okay, so corporate bond is more riskier as compared to the treasury bills because it is issued by the well-established private companies. But as we know, so private is a private sector. Okay, so whenever they are going well, they are having a good business, they are having the good revenue, good profit. So automatically risk associated with the your investment is less. If the company is facing some issues while generating the revenues, they are not earning the enough profits, so in such a situations, that it may be a case, it may be we consider default risk associated with such a type of investment. So that is we can say the corporate bonds. or we can say corporate loans. Now, next one is the blue chip stocks. So it is actually the share stocks issued by the well-established organizations like we can say the Reliance, Tata, Infosys, Cognizant, ACS. So all these are the well-established organizations, okay, whose shares we can say purchased by the investors, which are we can say the risk more risky than the treasury bills and the corporate bonds. So it is we can say the little bit risk associated with this type of share, because we know that if this company is not going well and if the situations are happen, that is the liquidation of the organizations. Okay, so in such a type of conditions that the shareholders are the real owners of the organization, so has to bear the losses. So we can say these are the more riskier than the treasury bills and corporate bonds. Now we can say the international stocks. So as we all understanding the international market in the subject international finance, we know there are the many of the risks associated with the international investment because of the political instability. We can say because of the currency fluctuations, geopolitical concerns. So all, because of all these things, the international stocks are more riskier than the treasury bills, corporate bonds, blue chip stocks, and the international stocks. And we can say the small caps and the startups are we can say the most riskier investment as compared to all the force investments, because we know that this is the new business idea. Okay, so it will we can say mm, succeed in the future or not, we can't say right now. Okay, it may succeed, it may not succeed. So if succeeds, that means you will get the higher return, because it's the highest riskier investment. Okay, so we can say the same, we can say with the same we can say risk, the return you will receive. That means you, if in startup, you will have the highest risk. You may get the highest return, but it may be high risk. If the startup failed, then you may lost your all the investments. Okay, so now we and because of this risk, okay, because of the different risk associated with the different investment, the investor made the portfolio because he wants the to reduce the risk. If I put all my money, all my investment in, we can say, into the startup, okay, if the startup not succeed, then I may lose my all the money, all the funds. Okay, so that means I'll be bankrupt. Okay, in so the investor don't want to want this. The what investor wants, he want to minimize the risk. Okay, so he may invest some amount in the treasury bills, some amount if we have the 100 rupees. Okay, so we invest 20 rupees in each of the options. That may we invest the 20 rupees in the treasury bills, we invest the 20 rupees in the corporate bonds, we invest the 20 rupees in the stocks, we invest the 20 rupees in international markets, then we invest the 20 rupees in the startups. Okay, if we lost the 20 rupees invested in a startup, okay, our 80 rupees is safe. Okay, from that 80 rupees I continuously generates the return. Okay, if the startup going well, the okay, so I will get the highest return in on this also. Okay, so this is how the investors made the portfolio. Okay, so we understand what how we can say the what is the portfolio variance formula. That is we can say the in the here that is the spreading investment across the multiple assets reduce the firm specific risk, what we call as portfolio, without necessarily reducing the expected returns. Okay, so we not compromise on the return sides. That means we can say without necessarily reducing the expected return, we made the diverse investments that we called as the portfolio management. Okay, so here the portfolio variance formula is the delta P square is equal to summation of I S to 1 to n. Okay, so wi square delta I square plus. So this is a very huge formula. You can take the screenshot. That is the summation of I to n raised to n. So summation of j to 1. Okay, so j2 I raised to n. So wi wj delta I delta j and the pij. So basically, I and J are the two different investments. Here, if you understand the formula, what it could be, so I and J are the two different investments. So for two different investment, we are going to calculate what is the portfolio variance. Okay, so W is the weight of the each asset. That means in the we can say in the in this example we uh, invested 20 rupees in each option that is available. So that means the weight of the each investment is the we can say the 1 by 5. Okay, so this is the weight. If we add all these 1 by 5 plus 1 by 5 plus 1 by 5 plus 1 by 5, so you will get the value is 1. So we will always calculate the weight as comparable to 1. That means their summation should be 1. The all weight summation should be a 1. So here W is the weight of each assets. Delta is the standard deviations. We can say the formula we already see in the last slides, and P is the correlation coefficient. So on that basis, we calculate the portfolio diversifications. So here the some of the risk return models that we are going to understand for one of the model, that is the capital assets pricing models, that is the ERI is equal to RF plus BI ERM minus RF, who measures the we can say the systematic risk associated with your investment. Okay. Now we can say for our investment, for doing any investment, so there are the two or three analyses are more important. That is, we can say the economical analysis, fundamental analysis, technical analysis. So all of these analysis we are going to understand in this chapter. So first we understand what is the fundamental analysis. So fundamental analysis is looking beyond the market prices to determine the true value of the investment. Okay, because we know that the prices in the market may get manipulated, but in the fundamental analysis we actually calculate the intrinsic value of the stocks of the any of the investments. So that's what we called as the fundamental analysis. So in fundamental analysis, what are the different we can say factors that we are going to analyze that we understand in a fundamental analysis. So fundamental analysis is nothing but a method used to estimate the security's intrinsic value. That is the true value. What is the true value of that stocks, that shares? Okay, that we are going to calculate it by doing the fundamental analysis. In some of the times, what happened because of the market mm, manipulation, that is the market frauds. Okay, you know this case of the Harshad Mehta scam. You might see the movie. So in this case, what happened? The some of the individuals or the organizations, financial institutions manipulate the stocks for their benefits. In if the investors not do the fundamental analysis, so he may we can say trap in a frauds. But if the investors or you as a teacher of the financial management, if you are good in the fundamental analysis, so you may understand the it is the fraud because by doing the fundamental analysis you can you know what is the true value or the intrinsic value of that stocks or the shares, because you will going to know that if you analyze that the prices of the stocks and the shares is on the higher level, but it is not the condition because the company is not earning that much revenue, that much profit. They are not doing that well in the market. How the prices of the stocks are at that level. so that you understand if you do the fundamental analysis first. Okay, so don't invest your amount of money if this someone tells you. Okay, if only by we can say viewing the any video on YouTube, or your friends tells you, anyone tells you that invest in that stock, so don't do that. First, do the fundamental analysis. Okay, so what are the key principles? So if we invest in any stocks or shares, okay, what we need to understand first. Okay, so market, you can say why the fundamental analysis is important, because the market prices may not reflect the true value. Okay, in some of the cases, as I told you, that because of the manipulation in the market, the market price may not reflect the true value of the shares and the stock. Okay, we can see the intrinsic value can be calculated. Okay, by doing the fundamental analysis, you will know what is the true value of the stock. The market price may eventually move towards the intrinsic value, may undervalued or overvalued, and because of manipulation, it may be in some of the cases it may happen that because if the any individuals or the corporation target any of the company to harm them or to damage them. So it may happen that they we can say spread such a we can say the loose stock in the market, and because of that the stock may be undervalued. So it may be happened in some of the cases. Now, what is we can say the economic analysis. In economic analysis, economic analysis is the part of the fundamental analysis. Okay. We can say while by doing the economic analysis, we are able to understand the market conditions. Okay, where the market is going on, what are the fluctuations in the we can say prices. Okay, so that we are going to understand. So first factor is we first analyze the GDP growth. Okay, so in any country in where we are going to invest, first uh, analyze the GDP growth, because GDP growth tells us the overall growth of all the businesses in that economy. If the we can say the GDP growth is very less in any country, that means the businesses are not growing at the fast pace. Okay, so if you invest in such a market condition, so you will not get the good return. So, though GDP, as so GDP is nothing but the gross domestic product. So GDP growth, we called it. If you, for example, if I tell you that if the in the Indian, we can say economy, if we produce in this year, that is the 25-26, that is the 100 crores goods and services. Okay. If the in the year next year, that is the year 26-27, if we produce the 110 crores goods and services, that means we produce the extra 10 crore goods and services in the next year. That means if we are growing at the space of 10%. So that is the concept of the GDP, that is the gross domestic product. Okay, so they invest we can say the countries which are growing at a fast pace. So businesses in that country is also growing at the fast pace. So the overall economic health and the expansion, we can say, which is still by the GDP to the investors. Okay, so the strong growth typically benefits the stocks, because the with the nations, the businesses are also growing at the fast pace. Okay, while the weak growth favors the defensive assets. Okay, if you invest in a weak growth economy, so you will get the less return, or you may have the losses as well. We can say the inflation, the rising prices erode the purchasing power. Okay, if you are investing in such a country where the inflation is on higher side, so in inflation, what happened, the overall prices of the goods and services are increases, and because of that the purchasing power of the customers or the consumer gets reduced. So the businesses are not in a position to sell the goods and services, we can say at the good numbers, and because of that they are not, we can say, growing at the fast pace. If the company is not growing at the fast pace, your investment is not growing at the fast pace. Okay, so the inflations, we can say the rising prices erode the purchasing power. The high inflation typically hurts the bonds, benefits, and the real estates like the commodities and all these things. So there will be, so the inflation is one of the major factor in economic analysis. We still see the investment is favorable or unfavorable. Next one is the interest rates. Okay, if the interest rates are, we can say, high, the customer will not take the loans. If the customers not take the loans, they are not have the enough amount of money to purchase the goods and services. So we can say rising rates typically pressure the stock valuations. Okay, uh, that means the, we can say, the lower interest rates are benefited to the investors. Next one is the unemployment. If you invest in such a country where the unemployment rate is high, that means the individuals don't have the enough income. Okay, so in such a economy, we always found a slowdown in the economy, that is the recession in the economy. Okay, because there is no demand for the goods and services in the economy. So we can say low, we can say the low unemployability typically signs the economic strength. Okay, so the, we can say countries should have the good unemployment. The good employment shows the, we can say, the strong economic signals. Okay, and that may lead to the wave inflation also. Okay, so all these four economic factors, whenever we do the investments, first analyze these factors. Okay. So the industry analysis, okay, sector-wise analysis, as we know, in the businesses there are different sectors, like we can say the software sector, pharma sector, automobile sector, okay, we can say the real estate. So all these are the different sectors. Okay, and the different sector has the different specifications. They have the different customers base. They have the different product, different services. Okay, so before going for the investment in any of the sector, first analyze that sector. Okay, so the key industry assessment factors. So what we analyze before doing investment in any sector is the growth rates related to GDP. Okay, yeah. So if the that sector, that industry is growing with the, we can say, the GDP rate or not. Okay, if I say the, if I take the example of the automobile sector, I want to invest in the Tata Motors. If the Tata Motors is growing at the 4% and the GDP is growing at the 7%, so my decision to invest in a Tata Motors is a wrong. Okay, so I can invest my amount in such a organization, in a such a industry which are going on the 8%. Okay, that will give me a more returns. So that we can say the GDP growth rate related to GDP, that analysis the maximum market size and the saturation level. Okay, so what is the market size? That means how much percentage they acquired the market for their products and services. If they acquire the good market, then you can, we can say, invest in such organizations. If they are having the less market size, then you may think of new the competitive landmarks and barrier to entry. Okay, so we can say what are their different competitors. Okay, what are the barriers to enter in such an industry. Okay, so if you analyze that, then you will get the idea if the investment is good or not. The regulatory environment and changes. So what are the, we can say, the regulatory bodies, what is the tax regime for that in industries, and all these things we are going to first understand and then go with the investment. Next one is the technology disturbance potential. As we know, I was gave you the example of Nokia. That in such an industry where the technology is changing at very fast pace, in such an industry that investment is very risky. Okay, because today all things are going well, But if the technology is invented by the other, their competitor is a very innovative as compared to the other organizations. So the customer base drastically shift to the other organizations. So in such a situations, we can say the technology disturbance potentials. You first analyze the technological advancement in the organizations where the investor are going to invest. Okay, and we can say so all these in factors we first analyze before doing the investments. Okay, we will also do the company specific analysis. Okay, if I select any organizations, any company for the investment, I first analyze their financial health and their competitive position into the market, and then only I go with the investments. That is, I first do the financial statement analysis. I told you in the subject the financial reporting, that is the realistic value infusion in the financial statement is more important for the different stakeholders to take the decision. So investor, we can say, refer the different financial statements for their investments. So first we analyze their balance sheets, their income statements, they are generating the profit or they are in losses, their revenue situations, expenses, profit margins, all these things. Okay, balance assets, their asset situation, liability positions, equity positions. Okay, their cash flow statement, operating, investing, and balancing. So all these activities we first we need to analyze. If we find it good, and then only we go with the particular company. We calculate the different financial ratios based upon the financial statements. Okay, we calculate the profit earning ratio, that is the PI ratio, that is the, we can say, we calculate the EBA, ITDA, that is the earning before interest and tax. Uh, Okay, so all these things first we are going to analyze. We also calculate different the profitability ratio, that is the ROI, ROE, we can say return on equity, return on assets. We calculate the different profit margins. We calculate the different liquidity ratio. In liquidity ratio, we understand the capacity of the repaying ability of the organization. That is the current ratio, quick ratio. We also calculate the solvency ratio. Their debt repayment capacity. Okay, so debt to equity ratio, interest coverage ratio, is the organization is capable to pay the interest or not? So that we first analyze all these factors. Okay, we also calculate some of the qualitative assessments, that is main management quality and their track record. Okay, so how the management take the different decision, what are their track records? Okay, the business model sustainability, what is their business model, what is their targeted base, what are their ethics, what is the vision of the organization, what is the mission of the corporation. So all, or we can say the competitive advantage, we analyze their different competitors. We also, we can say, the corporate governance practices. So all these things we find, so all these 12, 13 things, if we find well, and then only go with the company. Okay, if you find anything lacking in these 11 or the 12 points, do not go with that investment, guys, because that is the risky investment that may, we can say, have the losses you in the future. Okay, so here we stop. In the next point, we understand in the next session. If you have any question, you can ask me. We will have the 2 3 minutes. Okay, if anyone have any questions, you can ask me. Is the people is listening very carefully or not? Others Patil is there. So whoever names I am taking, please unmute yourself and tells me the yes, sir. Tejaswini Nirmal, Ankita Maekar,
Yes, sir.
Harshada who is this? Please tell you, Ankita. Ankita is there.
Yes, yes.
Harshada Jagdale, Harshada is there or not? Vaishnavi, Rangani, Vaishnavi, are you there? Please unmute yourself and give me the confirmation, guys. I want to know the how much student is listening very carefully. Vaishnavi Swami, Nayan Supekar, Darshan Chaudhary. Nayan Supekar is there or not? Vaishnavi Swami, Tejaswini Nirmal is there. Where Tejaswini? Priti Surve is there.
Yes, sir.
Okay, Ashwini Pawar, Ashwini Katkar. Okay, so guys, please try to listen the sessions carefully. Okay. Okay, so you may leave now. Thank you.